Hello and welcome to a presentation on moving towards efficient markets for private placements under new SEC Rule 506C promulgated under the Jobs Act and the Securities Act of 1933 as amended. My name is Seth Joseph. I am a corporate securities and transactional partner at Carlton Fields. This talk is about how these new federal laws will greatly facilitate the formation of capital for emerging and growth businesses. In 2012, registered offerings registered with the SEC amounted to $1.2 trillion. In the same year, private placements were $900 billion, but of that, offerings by operating companies, growth companies, companies that provide products, services, were a total of $173 billion, significantly less than the amount of registered offerings, and those offerings were conducted without general solicitation. As a result of the Jobs Act, now outreach may be made to accredited investors, both corporate accredited investors and individuals, by means of general solicitation. Individuals who constitute accredited investors are those with $200,000 of annual income, or $300,000 together jointly with their spouse, $1 million of net worth excluding the equity in their homes. The SEC stated in its adopting release that 8.7 million accredited investor households existed in the United States, and it's noteworthy that less than 1% ever had invested in private placements. Is that because they didn't want to invest in private placements? Or was there an inefficiency built into the system that caused some disconnect between those households and the opportunity to invest in private placements? The Jobs Act draftsman considered that it was something structural, and now the new Rule 506C allows companies that have securities to sell without registration to connect directly with accredited investors who would be interested. And that creates, because of this inefficiency or this disconnect, there's been pent-up demand. 8.7 million households of investors who have either $1 million of net worth to invest or making income at those levels. If we consider that on the average they have $100,000 to invest in private placements, that's a pent-up demand of $870 billion. I remember a couple of years ago when we were looking at, in the doldrums of 2009, the EB5 market, and considered the $800 million that was invested in EB5 deals as a tremendous opportunity. This is 1,000 times larger. 1,000 times larger, this program. Something really not to be overlooked. No one knows the actual size of this market, how many of those 8.7 million people are actually looking at this moment for private placement, to invest in private placement transactions. But usually the receptivity and the uptake is much faster than anybody predicts or plans. It reminds me of, in the early 1980s, the breakup of AT&T and home phones. Up until that point, you were required to have an AT&T rotary phone if you wanted service to your home, and you had the privilege of paying AT&T $7 a month for the use of that phone. Part of the legislation allowed you to buy your own phone and nobody could keep phones on the shelves during that period of time. The demand was so great. Now, there are a variety of means to use general solicitation to access accredited investor. The main vehicle, we believe, is going to be pay-per-click advertisements, because you can isolate very scientifically, very accurately, to high populations of accredited investors by zip codes and other limiting factors on your ads. And then you can triangulate that with very prolific searches that are done on Google that will bring you investors that are interested in the type of companies that you're trying to get funded. Banner ads are also effective to reach interest groups. Targeted campaigns, primarily email campaigns that have opt-in lists and are accredited investor target rich, are also a means of using electronic media to find your accredited investors. But the methods actually are quite broader than that. You can now publicly advertise and have people show up at seminars. And there are websites that are developing that have lots of accredited investors that have opted in to receive opportunities to invest in transactions. And there'll be many other flavors that come along. Now, the specific requirements of the rule to meet the SEC requirements to have a valid 506c offering is, first, you may generally solicit, but you may only accept subscriptions, receive money from accredited investors. The 506c offering may be integrated with other offerings that had non-accredited investors and cause a problem, but there are safe harbors from integration that can be followed, meaning that if you have a non-accredited investor-only offering, you must put 6 months of distance between the last sale under that transaction and your first sale under the 506c transaction. Not only must you have only accredited investors, but you must go through a process to validate and verify reasonably under the circumstances that all of your investors are accredited investors. And there are safe harbors that the SEC has pronounced as foolproof means to verify or to satisfy this verification that are detailed in the adopting release, and service providers who provide you safe harbor verification at approximately $50 per accredited investor are already available out there on the internet. All private placements under Rule 506 are now subject to the requirement that any covered person associated with the offering who had prior to September 23rd, 13, a bad act event must be disclosed. Bad act events are regulatory infringements of 8 varieties that are laid out in the rules. They generally consist of securities fraud or malfeasance associated with that, the commodities laws, mail fraud, a variety of financial misdeeds, and it is required that an issuer not only do the disclosures if one of these covered persons conducted a bad act after September 22, 2013, the offering cannot be done under the auspices of Rule 506C unless the relationship between that covered person and the company in the offering are severed. Again, it's important to do a verification whether any of the covered persons had bad act events. And again, many issuers are going to look for outsourced providers already available to do that work. Then there are the general requirements of any Rule 506 transaction. There's going to be a private placement memorandum. In the context of an accredited investor-only deal, the registration rules say that no particular form of disclosure is required. What that means is that no audited financial statements are needed. Compiled financial statements that are not misleading may be used. No particular disclosure items need to be covered. But generally, something approaching a full-blown private placement memorandum is going to be supplied so that one does not violate the anti-fraud rules, meaning that the information you provide to investors has to be what an investor would reasonably require to understand the investment, and there's nothing false and misleading about the information that you did supply. You've supplied enough information so that they're able to put that in a proper context. You are going to have to legend the securities to state that they can't be resold to the public, that they must be sold under some exemption from resale. And there are many exemptions that apply to the resale of those securities, but an investor needs to understand that this is not like buying stock on the stock market. That investment might have to be held for, the foreseeable future for an unlimited period of time. Finally, there's a requirement to file a Form D. Now, as of the date of this taping, there are proposed rules that are more draconian, but we're under the old regime right now, which require only a notice filing to the SEC 15 days after the first sale. Other rules are being talked about that would require you to file a Form D earlier and supply more elaborate information in those filings. But we will update this once the final rules on the Form D associated with a 506 offering are available. Now, in addition to filing a Form D at the federal level, one of the beautiful aspects of Rule 506C that in fact does not apply to crowdfunding, and all that you've heard about that, is the state regulation of the private placement is preempted, subject to allowing the states to get, at the same time that you file the Form D, you file in the states and you pay the states a very modest fee for the filing of that document. Otherwise, with a 506C offering, the states do not regulate that 506C offering. One of the great advantages of 506C is that an issuer is able to speak directly to investors. They do not need an intermediary. They're able to find accredited investors and speak directly to them about the merits of their offering. If, however, you decide in whatever context to use a broker-dealer or a finder in connection with a 506C transaction, then you're going to have state law issues, you're going to have associated federal issues to consider, and also, if it's a compensated solicitor, those aspects of the bad act events, we're also going to have to validate and verify whether that broker-dealer or finder has any of those items and disclose that in your private placement memorandum. One of the principal benefits of 506C is that the dynamic that's established for reaching investors has gone from an intermediary model to a direct to the consumer model. There's a lot of advantage in that, both in terms of eliminating a gatekeeper that had its own biases. You will no longer, if you do a 506C deal going direct to the accredited investors, pay compensation of 6, 8, 10% and warrants to an intermediary. The intermediary receiving warrants or this compensation will generally want to drive the price of the securities down, especially in the case that he's getting warrants. He'll want to look out for the interests from his, paternalistic point of view of the investors. And the absence of all of that dynamic is going to provide issuers with much greater flexibility in terms of pricing and terms. One of the things that we need to determine at the outset of an offering is at what price per share are we going to offer the securities? And that really presumes that we have a pre-money valuation for the company. Now, instead of having an intermediary to decide that, the issuer gets to decide what its valuation is going to be, and then offer that. In the pay-per-click world, we're getting investor feedback on an hourly and daily basis. And to the extent that we have not optimized that level, we can start a new campaign to a new group of individuals and change that on the fly. Same thing with if we're offering common stock with no preferences and there's resistance, there's an ability to move into a different structure. Offer size. We're able to set the offering where a critical mass of money is obtained and then there's room to raise more money, or we can cut off an offering and move directly into a new offering at a new level and on new terms. What you're going to need to put together to do your transaction is a deal team. A key person on the deal team is the resource to help you develop what your ads are going to be. Typically, what we expect to see developed is a short PowerPoint video that's the basis for the ad campaign or campaigns. And typically, it's going to be 10 or more campaigns going on simultaneously in the beginning to see what works and what brings you your best traction. They will place those ads for you and provide you with up-to-the-minute information so that you can shift from less successful campaigns to more successful campaigns and keep refining the message. This is not a set it and forget it kind of advertising. This is immediate feedback from the market, change, continue to morph that. Then on the legal side, you'll need a law firm to develop your private placement memorandum that works closely with the marketing team, so the marketing materials that are going out in the general solicitation describe the same company as they'll be reading about later in the private placement memorandum. And then, of course, you're going to need somebody on the team to do verifications. We expect to see further delineation of services that can be offered to an issuer. That's great in their own business, whether it be software, biotech, whatever. But this business of selling securities is a little bit different than selling the regular products, and those services are greatly valuable. My name is Seth Joseph. You can connect to me on LinkedIn. I have a law firm email, and I'm glad to talk to you further about these exciting developments with Rule 506C.